The union budget that was presented by Finance Minister Nirmala Sitharaman on 1st of February received a thumbs up from analysts, economists and CEOs alike. But the capital market reaction has not been so enthusiastic. On the budget day itself, benchmark indices ended on a flat note. On Monday, they fell further. The BSE Sensex was down about 500 points in afternoon trading, and the NSE Nifty50 index was also down about 200 points. Now there are internal as well as external reasons why the market has been falling today. Now let's start with the internal reason first. Now obviously the budget was the most important thing everybody was watching out for. With the economy slowing over the last few months and high food inflation denting urban consumption demand, there were growing voices that in the budget the finance minister will have to do something for India's vast middle class. On that front, the finance minister has truly delivered through income tax measures. Now people earning income up to 12 lakh rupees will not have to pay income tax at all. Also, the income tax slabs have been revised to such an extent that now people earning between 12 lakhs to almost 24 lakh rupees will also pay a lower income tax. That should leave a sizable amount of money in the wallets of the Indian middle class, and that should translate into consumption going ahead. While doing so, the government has remained firmly on the fiscal consolidation path as well, projecting a lower fiscal deficit for the upcoming financial year. Now, in the anticipation of consumption pickup, FMCG companies, shares of consumer durables, shares of real estate companies, as well as other consumer-facing stocks have seen a sharp up move on budget day, and some of them have continued to move up on Monday. But at the same time, core sector companies, shares of capital goods makers, infrastructure companies, engineering companies, they have been under intense selling pressure. Take companies like Siemens, take companies like CG Power, Larsen & Toubro, NBCC, Bharat Heavy Electricals and the like. Now the key worry among investors here is that the government this time around prioritized consumption over capital expenditure. Now in the last few years, the government has been doing the heavy lifting when it came to investment and capital expenditure. This time around, the worry is that it has not focused a lot on that. Well, to be fair, if we look at the actual numbers, now the capital expenditure projected for 2025-26 financial year is actually 10% higher than the revised budgetary numbers for the current financial year. But as economists point out, as a share of GDP, the capital expenditure allocation has remained flat at 3.1%. Notably, while defense expenditure has gone up 13%, but at the same time the budgetary allocation towards roads and railways has also been flat. And that is exactly why shares of railway related companies have fallen sharply over the last two sessions. Well, these were the internal factors that were impacting stocks on Monday. Now externally, over the weekend, US President Donald Trump unleashed a new trade war. He announced a new set of tariffs on neighbors Mexico and Canada, as well as levying new tariffs on China as well. Now, while Mexico and Canada have retaliated with their own measures, China has also vowed retaliation to the US tariffs. Now, all this will fuel a new round of trade war around the world and fuel more global economic uncertainty. In this backdrop, foreign investors continue to pull out from emerging markets, including India, as they go back to the safety of the US dollar. In India alone, foreign portfolio investors have sold off more than 70,000 crore worth of shares in the domestic equity market in January 2025. And it is likely that the FIIs will continue to sell amidst this global volatility. All eyes will now move on to the RBI's Monetary Policy Committee meeting. The MPC meets later this week, and this will be the first Monetary Policy Committee meeting under new RBI Governor Sanjay Malhotra. Now, Sanjay Malhotra has very many things to consider. One, with the economy slowing and the inflation cooling, the expectation was that the RBI will start cutting interest rates from this coming MPC meeting. That expectation still holds, but don't expect steep rate cuts from the RBI. At best, a 25 basis point cut this time around. There are two things that the MPC will be closely looking at. One obviously is this whole boost that has come to the consumer sector in the budget. How this pans out and whether it fuels inflation over the medium term is something that the RBI will be closely watching out for. The other thing it will be watchful of is also the rupee-dollar equation. Amid the huge FII sell-off that we have seen over the last few months, the rupee has continued to sharply depreciate against the US dollar. On Monday, the rupee fell past the 87 to $1 mark, and that is something which the RBI will have to consider as well.